What if I told you that blowing prop firm accounts is actually a good thing? What if I told you that the secret to passing funded accounts quickly isn't about being conservative and risk averse? It's about being an aggressive portfolio manager. Most traders are playing the funded account game completely wrong. They're bleeding money, not from bad trades, but from time. They're playing by the prop firm's rules instead of rigging the system in their favor. And today I'm going to show you the exact mathematical framework that turns a few $100s worth of prop firm accounts into potentially thousands in payouts by treating prop firm accounts like a portfolio, not a single shot at glory. If you're serious about making money with funded accounts, this is the only video you need to watch in 2026. All right, let's start with the biggest misconception in the entire prop firm industry. You buy a $50,000 funded account challenge, you get excited. You think that you have 50 grand to play with. You don't. What you actually have is the drawdown. For a typical $50,000 account, that might be a $2,500 or a $3,000 trailing drawdown. That's your real account size. That's what actually matters. The moment that that number is breached, the $50,000 evaporates. It was never really there. Let me explain exactly how this works because understanding this is critical. When you buy a prop firm challenge, they give you what looks like a massive account. 50 grand, 100 grand, maybe even 300. But they also give you rules. And the most important rule is that drawdown limit rule. There are two types of drawdowns: static drawdown and trailing drawdown. Static drawdown is simple. It's calculated from your starting balance. So if you have a $50,000 account with a $2,500 static drawdown, you can lose that $2,500 from your starting balance before you're out. So for example, if you start at $50,000 and you drop down to $47,500, you are done. You blew the account. But most prop firms use trailing drawdowns, and this is where it gets a little bit tricky. Trailing drawdown moves with your account as you make profit. So let's say you start with a $50,000 account and a $2,500 trailing drawdown. Your drawdown threshold starts at $47,500. Now, if you take a few good trades and you're up to $52,000, your trailing drawdown doesn't stay at $47,500. It moves up with you. Now it starts at $49,500. So you're up 2 grand, but you only have $2,500 of breathing room. And here's the psychological trap. You see 52 grand in your account and you think you're managing a big book. You think you need to protect the capital, you start trading smaller and you start being more conservative. But the reality is, you're not managing 52 grand. You're managing a $2,500 buffer. That's it. And this is exactly what prop firms want. They want you to feel like you're trading a huge account so that you trade small and you take longer to pass and you pay more and more and more in renewal fees. It's a psychological trick designed to make you play their game by their rules. And most traders completely fall into their trap. They think, I need to protect this 50 grand, but there's nothing to protect. The 50K was never real. It's just a number on a screen designed to manipulate your behavior. What you're really trading is that drawdown. And once you understand that, everything changes. Let's talk about how prop firms actually make their money. Prop firms are brilliant. Let's just say it how it is. They've built an incredible business model. They offer you a shot at 50 grand, 100 grand, or even a 200 grand account for a very, very small upfront fee, or so it appears. You might pay 200 bucks for a $100,000 challenge. You might pay 100 bucks for a $50,000 challenge. Seems like a great deal, right? You're thinking, if I can just pass this challenge, I'll have access to 100K in capital. I can make thousands of dollars in payouts. This is the opportunity that I've been waiting for. And trust me, it's a very big opportunity. But there's a catch: the monthly renewal. If you don't pass that challenge within 30 days, you get hit with another fee and another and another and another. Let me show you exactly how this plays out for most traders. You buy a $100,000 account for $150. You're excited to start trading, but you're scared. You don't want to blow the account, so you trade small, you take conservative setups, and you aim for consistency. A week goes by, you're up 500 bucks. Not bad, but you need $10,000 to pass. You're only 5% of the way there. 2 weeks go by, you're up $1,200. You're finally starting to make progress, but it's super, super slow. 3 weeks go by, you hit a losing streak, and now, unfortunately, you're back down to only $800 in profit. 4 weeks go by, you're up $1,500. You haven't passed, you haven't failed, but the 30 days are up. Now, you get hit with the renewal fee. Another $150. You think, okay, I'm close, I'll just pay the renewal and keep it going. Another month goes by. You're up $3,000 now. Still not enough to pass. Another renewal, another $150. So now your initial $150 investment is now $450 because of all the renewals, and you're still not funded. Another month, another renewal, you're now at $600 invested that's just going straight into these prop firms' pockets. And here's the brutal reality. You've now spent $600 trying to get a payout from an account that you could have just bought 4 times over. You're bleeding money not because of bad trades, but because it's simply taking you so much time to pass. And this is exactly how prop firms make their money. See, most traders never pass, and the ones who do take so long that they've paid 3 times, 4 times, sometimes even 10x their total initial investment in renewal fees. The prop firm doesn't need you to fail. They just need you to take your sweet time. They want you to play it safe. They want you to be conservative. They want you to treat it exactly like a live account, because the longer you take, the more you pay, and the richer that these people get, and believe me, they are getting very rich. And this is where most traders go wrong. They think the game is about passing the challenge, but the real game is about passing the challenge as quickly as possible to avoid renewal fees. If you take 90 days to pass a challenge and you're paying $150 a month in renewal, you've spent $450 on top of your initial fee, and your total investment is now $600. Meaning when you get your first payout of $1,000, you're barely breaking even. That's not a win, that's a loss. So what's the solution? You need to pass fast or you need to fail fast. No in between, no slow and steady, no conservative approach. You need a result, and ideally you need it in under a week. Now we are going to flip the entire model on its head. Stop thinking about it as one account. Start thinking about it as a portfolio of lottery tickets where we can mathematically engineer a massive result. Let me show you exactly how this works. Most traders buy one account and put all their focus on that one account. They treat it like it's their only shot. They trade it carefully and they protect it. And when they blow it, they're devastated. They feel like they failed and they have to start all over again from zero. But what if you didn't buy one account? What if you bought 20? Now, before you say, I can't afford 20 accounts, let me show you the math. Prop firms run sales all the time. Apex, one of the biggest firms ever, often has 90% off sales. During these sales, you can get a $50,000 account for $20, $20. So instead of buying one $50K account for $200, you wait for a sale and you buy 20 accounts for $400. Now here's where it gets interesting. You're not trying to pass all 20 accounts. You're playing a numbers game. You need a system to pass them. Not a conservative, slow and steady system. You need an aggressive, pass or fail quickly system. Let's say your system has a 60% win rate for passing challenges within a week. That means that 60% of your accounts will pass and 40% of them will blow. So let's do the math. You start with 20 accounts. You invest $400 total. You trade them aggressively. You're not trying to protect them. You're trying to get a result. Pass or fail as quickly as possible. After 1 week, 40% of your accounts are blown. That's 8 accounts gone. You don't care. It's part of the model. You expected this. You're left with 12 passed accounts. Now here's the key. You pass them in under a week. No renewal fees. Your total investment is still just $400. Now you're in the funded stage. And here's where the second part of this model comes in. Even with a good strategy, you are going to have some losing streaks. You're going to have drawdowns. Some of your funded accounts are going to blow before you even hit the first payout. So let's be conservative and say that 50% of your funded accounts get blown before the first payout. You had 12 funded accounts. Now you have 6 accounts that are eligible for a payout. Let's say the first payout on a $50,000 account is a modest $2,000. What's your return? 6 accounts times $2,000 in payouts means you just made $12,000. You turned a $400 investment into $12,000. That is a 30x return on your initial investment. That is a much better play than trying to trade one account and losing all that money to renewal fees. And here's the best part. You did it in under 2 weeks. No renewal fees, no wasted time, no bleeding money. Now let's compare this to the traditional approach that most people take. Traditional approach is that you buy one $50,000 account for $200, you trade it conservatively, you take months to pass, you pay $200 in renewal fees, your total investment is $400, and you finally get your payout of $2,000, but your net profit was only $1,600. With this new approach, you buy 20 $50,000 accounts for $400, you trade them aggressively, you pass 12 in under a week, 6 hit payout, you make $12,000, and your profit is $11,600. Same investment, completely different outcome. And the difference is simply mindset. The traditional trader is trying to protect one account. They're scared of losing. They're playing not to fail. The portfolio trader is playing to win. They're accepting that some accounts will blow. They're focusing on the accounts that pass. They're letting the math do the work. This is how you rig the system in your favor. This is how you play the game the way that it's actually meant to be played. You're not trying to be a perfect trader, you're being a smart investor. Let me be very clear. Blowing accounts is not failure. It's a statistical reality. If you're trading with the real edge, you're gonna have losing streaks, you're gonna have drawdowns, and you're going to blow accounts. That's how trading works. But if you're managing a portfolio of accounts, it doesn't really matter because the math is on your side. Think about it like this. Venture capitalists don't invest in one startup and hope it works. They invest in 20 startups, knowing that 15 of them will fail, 3 will break even, and 2 of them will become unicorns, meaning they'll get 100x on their investment and the companies will end up being billion-dollar companies. That's portfolio management. I have friends in venture capital, and they're not devastated when 15 of their startups fail. They expected it. It's built into the model. What they care about is the 2 to 3 that succeed, because those 2 will generate enough return to cover all the losses and still produce a massive profit. And that's exactly what we're doing with funded accounts. We're not putting all of our eggs in one basket. We're not working on one account for a month, being conservative, and then blowing it, having to restart. That's how they want you to play the game. We're playing it differently. We're buying multiple accounts, trading them aggressively with a proven edge, and letting the math do the work. Some accounts will blow. Sure, that's expected. That is built into the model. But the ones that pass will more than cover the losses, and the ones that hit payout will generate returns that most traders can't even imagine. Now here's the key. You need a real edge. You need to actually be using a profitable strategy in order to do this. You can't treat it like Vegas. You can't just buy 20 accounts and trade randomly and hope it works out. You need a strategy with a proven win rate. You need a system that gives you high probability setups day in and day out. And that is exactly what I'm going to show you next. Before we get into the strategy, let me quickly break down all the rules that you need to understand. Every prop firm has slightly different rules, but they all follow the same basic structure. The first rule is the profit target. To pass the challenge, you need to hit a profit target for the $50,000 account. That's usually $3,000 to $5,000, and for a $100,000 account, it's usually 10 grand. This is your first goal. Hit the profit target and you're funded. The second rule is your drawdown limit. As we discussed earlier, you have a drawdown limit. This is usually 5 to 10% of your account size. Breach this limit and you're out. The third rule is the daily loss limit. Most firms also have a daily loss limit. This is usually 2 to 5% of your account size. If you lose more than this in a single day, you're out. This is important because it means you can't just go all in on one trade. You need to manage your risk on a per trade basis. Rule number 4 is minimum trading days. Some firms require a minimum number of trading days before you can pass. This is usually 3 to 5 days for most firms. This means you can't just get lucky on one trade and pass immediately. You need to show consistency over a few days. Rule number 5 is that there's no news trading. Most firms don't allow you to hold position during major news events. You need to be flat before high impact news releases. Now here's what most traders don't understand. These rules are designed to make you trade very conservatively. They're designed to make you think, I need to protect this account, I need to be careful, and I can't take big risks. And that mindset is exactly what keeps you stuck in the renewal trap. Because if you're trading too conservatively, you're not going to hit your profit target quickly. You're going to take weeks or months, and you're going to pay renewal fees the entire time. So the key is to trade aggressively enough to hit your profit target quickly, but not so aggressively that you breach your daily loss limit or your drawdown limit. And that's where the strategy comes in. Now you can't just guess. You need a simple, repeatable strategy with a clear edge. Our entire model is built on trading liquidity. What is liquidity? Liquidity is an area on the chart where there's a cluster of orders, stop losses, pending buy orders, pending sell orders. It's where trapped traders are sitting, waiting to exit their positions. And institutions need liquidity to fill their massive positions. Think about it. If Goldman Sachs wants to buy $500 million worth of ES contracts, they can't just click buy and get filled instantly. They need liquidity. They need sellers on the other side of that trade. So what do? They engineer moves to key liquidity levels, places where they know there are trapped traders and stop losses, and they use that liquidity to fill their positions. And once you understand this, you can follow the money. So where are these liquidity levels? Every single morning, I mark 3 types of levels on my chart, and I'll show you them right now. The first level that I mark out every single morning is very, very simple. It's the first 15-minute candle at 8 a.m. from 8 to 8:15 a.m. Eastern Standard Time. I mark it out just like this on the 15-minute time frame using this rectangle tool. Why is this so important? Because this range traps early traders. Some traders went long at the bottom of this range, some traders went short at the top of this range. So when price breaks out of this range, those traders are trapped. They have to exit, and them exiting their position creates momentum. For example, when shorts have to exit their shorts, they buy back into the market, which further fuels the buying pressure, as you can see right here. The next levels that I mark out are untested session highs and lows. For example, these are levels that have not yet been tested. This level was just tested, so I'd remove that. So was this level, this was from yesterday. So now we would just be looking at these levels right here. I am looking at untested session highs and lows from the London, Asia, and New York trading session. And I mark out the highs in black and the lows in blue. Just this morning, I took a beautiful trade off of an untested session low from a few weeks back that gave me a beautiful bounce. So why are these levels important? Because there are trapped shorts above these levels, and if you're short and price is moving up towards a previous session high, you're gonna get nervous. Your stop loss is probably sitting just above that high. And there are also pending buy stop orders above these highs, so traders who think price is going to break out are sitting with buy orders above the high, waiting for confirmation. So when price moves up to test an untested session high, there's a cluster of orders sitting there. That's liquidity. If price gets rejected at that level, it means the sellers are stronger than the buyers, and we can trade that projection. With untested lows, there are trapped longs below these levels. And if you're long and price is moving down toward a previous session low, you're probably getting a bit nervous. Your stop loss is probably sitting just below that low. And there's also pending sell stop orders below these lows. Traders who think price is going to break down are sitting with sell orders below the low, waiting for confirmation. So when price moves down to test an untested session low, there's a cluster of orders sitting there. That is liquidity. If price bounces at that level, it means that buyers are stronger than the sellers, and we can trade that bounce. The key word here is untested. If a level has already been touched, it's no longer as powerful. We only trade untested levels because that's where all the orders are sitting, and that's when we're gonna have a good reaction. After price interacts with the level, those orders are already filled. The trap traders have already exited, and the pending orders have already been triggered. The level loses its strength. So every single morning, I mark the 8 to 8:15 a.m. Eastern Standard Time candle, and I mark any untested session highs and lows. And then I wait for one of 3 simple trading setups. Let me break down all the setups that I trade on the chart so you understand exactly how to use them, and I'm gonna actually use real trade examples of recent trades that I took. The first setup is the break and retest. The break and retest is my highest probability setup, and it's my favorite setup. Here's exactly how it works. Step 1. Mark out the first 15-minute candle from 8 to 8:15 a.m. Eastern Standard Time. At 8 a.m., the New York session opens, and I mark this entire candle out. Remember, this is 8 a.m. Eastern Standard Time. We're marking out the candle at 8 a.m. because we want to catch the volatility that happens at 9:30, and you guys will see exactly what I'm talking about in a second. This range traps early traders. Some traders went long at the bottom of this range, some traders went short at the top of the range. And when price breaks out of this range, these traders are trapped. Step 2. Wait for a break either to the upside or to the downside. I don't trade within the range. I wait until price has broken either above this zone or below this zone. If price is 5 to 10 points above, that's a break to the upside, or if it's 5 to 10 points below, that would be a break to the downside. This break signals that institutions are pushing price in one direction and trap traders are being forced to exit. Let's say at 9:15 a.m., price is trading at 4,512. Clearly below the midline of 4,517. This is a break to the downside. Step 3. Wait for a retest of the midline. After the break, price will often pull back to retest the midline of the 8 to 8:15 a.m. Eastern Standard Time candle. Why? Because trap traders who were sitting at that level are now exiting their positions at break even, thinking, thank God, I just got out without a loss. So when price retests the midline, they sell if it was a long, or they buy back if it was a short, like what happened today, and this further fuels the move back up. Step 4 is to enter the trade on the retest, and I actually like to go down to the 5-minute and observe exactly what's happening right here at the midpoint. And once I see that this midpoint is being respected, meaning price is not closing below it, I like to enter. So on this day, I entered specifically right here, and I was able to catch around 20 points with a 5-point stop loss, giving me a risk to reward of 1 to 4, and that was a beautiful trade. I was very proud of that trade. I entered right here at this midpoint. My risk to reward was 1 to 4. I caught 20 points on this trade, and I was actually only in this trade for about 10 minutes before I got out. Now let me show you why this setup works. When price breaks the opening range, it's telling you that institutions are pushing price in one direction. The trap traders are being forced to exit, and that creates momentum. But price rarely moves in a straight line. It breaks, and it pulls back, and it needs to retest the level to gather more liquidity before continuing. And that retest is exactly where you enter. You're not trying to predict the break. You're waiting for the break to happen, and then you are trading the retest. This is a high probability setup because you have confirmation. You know which direction institutions are pushing, you know where the trap traders are sitting, and you're entering at a level where you have a clear invalidation point. If price were to break back below this midpoint and close under it on the 15-minute time frame, we would be wrong and we would take our loss. But if price breaks out to the upside, retests the midpoint and continues moving up, we are right and we get paid. The second setup is a bounce off of an untested low. Every single morning, I mark out the untested highs and lows of the New York, London, and Asia trading session. The key word is untested. Price has not yet touched these levels. For example, I had an untested session low at this London low that was actually from a few weeks back, but price still hadn't hit this level, so all the traders who are trading around here are still trapped, meaning when price does hit this level, it's likely to have a big reaction. I am looking for a very specific reaction, right? And the other thing to notice is that these levels had already been tested, right? We bounced off of this low in Asia session, so I wasn't looking at that low. I was only looking at this low, and what I do is I go down to the 5-minute time frame and I observe if price is showing strength around this level or weakness. Today, it was very clear to me that price was indeed showing strength. We bounced up 35 points, retested this level, and then ended up closing above it again, which is where I entered. I had a stop loss of 8 points. I targeted 25 points, and I made around $15,000 on this specific trade today. And the other thing to note is that price actually has been slightly rejecting off of this high and off of this high, right? So you could have taken that trade, you could have taken this trade, but today I decided to take this trade. You also could have taken this bounce off of this Asia low right there, right? So you could have marked out this low and you could have said, you know what? I don't want to take this trade. I actually want to take this trade right here. And you would have been able to catch a lot of points. You'd be able to catch 45 points with a stop loss of only 7 points. So that would have been around a 1 to 5 risk to reward for you right there. Reason I'm showing you that is just to show you guys how powerful these levels are. The reason we want to be trading powerful levels is because trades like this is what is going to allow us to pass our funded account, because we are risking a little bit of money and we are getting a lot of money back. You can hit a few trades like this and pass a funded account. So just to recap, I like to mark out all my highs and lows, and then I like to go on the 5-minute, the 15-minute time frame and observe strength or weakness of this level. For example, if this level had any 15-minute candle closures below it, I would not have entered. I simply observed that there was no candle closures below this level, and even this is not a candle closure below. For a level to be considered invalidated, I need a full candle closure below it. So I would need this entire wick to be below this level, not touching it at all. When this happens, when we actually have a wick that's touching it and then we close back above it, that is actually a sign that we're going to reverse. Now this next setup is so incredibly simple, and it's literally the opposite of what we just looked at. So you guys can probably guess, but now we are going to look at rejections off of highs. So we just looked at a bounce off of a low. Now we are going to look at a rejection off of a high. And I'm not going to go too in depth on this because it's the exact same principle as what you're looking for with a bounce, except it's reversed and you're looking for shorts. So right here, you can see that we have all of our untested highs and lows marked out. This level had already been tested, so at this level, so this is our next untested high. And I went on the 15-minute time frame. I saw price tap this high once, so I told myself if price has a 15-minute candle closure under this level, I'm going to look to enter shorts. Ideally, we get a retest of this for a better entry, but we didn't get that retest, so I entered right here with a stop loss of 6.5 points, targeting 26 points, giving me a 1 to 4 risk to reward ratio, and this trade was awesome. I did exit a little bit early, not mad, but if I ended up holding this trade, I would have made around $45,000 in a day. I made $17,000, which, is amazing, but obviously, that one stings a little bit. The key thing to observe here, guys, with bounces, with rejections, and even with break and retests is you want to be able to identify strength or weakness of a level. And you can do that by going on the 15-minute and the 5-minute and observe who's taking control. Right here, it was pretty clear to me that sellers were taking control and that nobody wanted to buy for over this price, right? If price immediately broke through this high, just like it did right here, I would not have traded it. For me, it was pretty clear to see that this high was not being respected, neither was this high, but this high was being respected. Your ability to determine the strength or weakness of a level is one of the things that will determine if you are a profitable trader. You're not trying to predict whether price will bounce or reject. You're waiting for price to show you what it's going to do, and then you're trading the reaction. This is a high probability setup because you have confirmation. You know where the liquidity is, you know price tested the level, and you're entering based on the reaction. If price breaks through the level and closes above it or below it on the 15-minute time frame, you're wrong. You take your stop loss and you move on. But if price respects the level and reverses, you're right, and you get paid. Now let me show you why this strategy is perfect for the prop firms. These setups have a proven edge. They work because they're based on institutional order flow and liquidity. When you're trading 20 accounts, you need a strategy that gives you a real edge. You can't just act like you're going into a Vegas casino and hope it works out. This strategy gives you that edge. The second reason this is so great for prop firms is because you trade it only within 8 a.m. and 10 a.m. Eastern Standard Time. That's 2 hours max. This means you can execute across multiple accounts without being glued to your screen all day. You mark your levels, you wait for your setups, you take your trades, and then you are done. The third reason is that this strategy has very clear risk management. Every trade has a defined stop loss and a defined target. You know your risk before you enter. This is critical for prop firms because you have a daily loss limit. You can't just go all in on one trade hoping it works out. With this strategy, you're risking a small defined amount on each trade, and you're aiming for a 1 to 3 or a 1 to 4 risk to reward. The fourth reason is that you can get fast results because you're not looking to slowly grind your way to the profit target over a few weeks or months. You're taking high probability setups with good risk to reward, and you can hit your profit target in 3 to 7 days. That means no renewal fees, and that means you're passing accounts quickly and moving on to the funded stage. This is exactly what you need for the portfolio approach. Now, I've shown you the math, I've shown you the strategy, it works. But here's the reality. It still requires you to be there, executing perfectly across 20 different accounts, managing your emotions, and staying disciplined. And that's where this gets really interesting. For the past 2 years, we've been perfecting a system to do this for you. We've developed an algorithm specifically for this portfolio approach We call it SurgeBot. It's designed to do one thing: pass prop firm challenges as quickly as possible. It uses the exact strategy I just showed you, but it does it automatically, where it manages the risk, it takes the trades, and it operates across as many accounts as you want. Our internal data shows that it passes accounts at a 70% win rate, almost always in under a week. It plays the game it's meant to be played aggressively, systematically, and without emotion. No hesitation, no second guessing, no missed opportunities. It executes the strategy perfectly every single time. And the results speak for themselves. I cannot break down the entire system in a short YouTube video. It's way too in-depth, but I've recorded a separate private presentation that shows you everything: how SurgeBot works, the back-tested results, the live performance data, and how our clients are using it to generate payouts consistently. If you're tired of playing the prop firm game by their rules and want to actually win, click the link in the description below. It will take you to a full breakdown where in that video I will break down the complete SurgeBot system and how it passes funded accounts at a 70% hit rate, the exact portfolio strategy we use to turn a few $100 into payouts worth thousands and thousands of dollars, the full back-tested results and live performance data, and how the done-for-you model works so that you don't have to execute manually. So whether you decide to keep trading manually using the portfolio approach I just showed you, or you want to see how the automated system can take this to the next level, I want you to succeed. So go watch that video. It's completely free, and it might be the most valuable hour that you spend this year. The link is in the description of this video. So stop trading one account, start building a portfolio, and let the math do the work for you. I'll see you in the next video. Until then, keep learning, keep growing, and stay consistent, everybody. Peace out.